So in the 1990s, something amazing happened. We had incredibly robust, awesome economic growth, and rates stayed pretty low for the most part. And it was this weird anomaly. And it wasn't because the internet was invented. The reason this happened was because the Berlin Wall fell. Okay, this is fascinating. Alan Greenspan actually, he came and he guest lectured to us when I worked at Citadel, and it blew my mind what he said. He said that when Reagan, remember Reagan made that statement we watched or we talked about in the presentation section, tear down this wall. Well, what happened then was, according to Alan Greenspan, the wall fell, and the Berlin Wall fell. Communist was no more, and all this incredibly intelligent, cheaper labor in Eastern Europe moved to Western Europe. And the biggest input into inflation rates, meaning prices going up, is labor. And so labor costs were kept artificially low. And the government usually raises interest rates when the economy is doing incredibly well. And when the economy is doing really, really well, then the price of everything goes up because everyone has more money and they're buying more stuff. And in order to keep prices from going up too much, the government raises interest rates. But they didn't do that much in the 90s. Why? Because you had this incredible influx of cheap and highly intelligent labor from Eastern Europe moving west. And as a result, we had unprecedented economic growth at relatively low interest rates. I missed the 90s. Okay, so if debt is secured via access to assets upon default, then this is called senior debt. Okay, so let me reword that. Okay, so senior debt means they have the first claim on your company if your company goes belly up. Okay, and then stuff that's not senior debt, meaning it has less rights, or it's lower down the pecking order in terms of getting their money back. That's called subordinated debt or junior debt. Okay, no more debt. Let's talk about risk and return. So how can I quantify my return on investment using several different scenarios? Okay, so some of you took statistics in high school or university and you thought, oh my God, I'm never going to use this crap ever. But we will now, just very briefly. Okay, so let's talk about expected return, right? And so you could come up with different scenarios to kind of gauge how you're going to do on an investment. Okay, and you can probability weight it as follows. I'll give you an example. Let's say there's a 25% chance that the economy is doing very well. And if it's doing very well, then a stock you invested in will go up 50%. Okay. But there's a 50% chance that the market or the economy is only going to be lukewarm. In that case, your stock you're investing in or your investment goes up 20%. And then there's a 25% chance that we're in an awful economic environment. And in that case, say the investment goes down 30%. So what, Chris? Well, your return probability weighted would be as follows. 25% probability times a 50% return plus 50% probability times a 20% return plus a 25% probability of the worst case or minus 10% or whatever it was. Right? I'll add all that stuff together and that's your expected return on investment. You don't have to use this stuff, but I'm exposing you to a little bit of statistics, not too much. Almost done with this, Ken. So how can I quantify how wide of a difference in returns I should kind of expect? All right. Well, it's something called the standard deviation. You're like, oh yeah, I covered this stuff years ago. Well, it makes a little bit of sense to look at the standard deviation. And I'll go through this really fast, okay? So what, Chris? What does standard deviation mean? Well, let's say that your expected return or the average return you expect on an investment is, say, 20%, right? And you can make more money or less money based on different scenarios. And the standard deviation is 31. Don't turn me off yet. What that means is 20% is what you think you'll get for your investment, but 31 is your standard deviation, which means that there's a probability that you'll be 20% plus 31, meaning 51%, or 20% minus 31, okay, meaning minus, I think it's 10% or 11%, whatever it is. So what that means is you have a one standard deviation probability of getting a return of 20% plus or minus 31. And one standard deviation means a probability of 68%, okay? And two standard deviations away from the mean means a probability of 98%. And statisticians love this stuff. I'm not going to talk much about this. So risk-averse lenders, right? So banks prefer to lend to people or to companies that have a lower standard deviation, okay? So a less variance in the returns, okay? So this makes sense. Okay, so I get it. I understand that standard deviation means how spread out risk returns are, but is there a formula to measure risk and returns? There is. It's called standard deviation divided by the expected return. And this means how much risk am I taking on per additional unit of return? Okay, we're done with that. No more stats. Let's talk about the cost of equity capital. Okay, we talked about cost of debt, right? Remember we used just Moody's and Standard & Poor's for debt just to calculate the cost. Okay, so let's talk about the cost of equity capital. So we expect public equity returns to be the risk-free rate, which includes inflation, meaning the cost of getting capital for next to nothing from the government plus inflation, plus how volatile a stock is relative to the stock market, okay, that's called the beta, times how much we expect stocks to outperform government bonds over time, okay? Bear with me. Okay, so again, we expect return on stocks or equity to equal the risk-free rate plus the beta, which is how volatile our stock is relative to the market, times how much we expect stocks to outperform government bonds. Okay, so how do we calculate the cost of capital if we use equity and debt? Well, there's something called the weighted average cost of capital, okay? And just think what that means, the weighted average cost of capital. So you just take the average between the cost of your debt and the cost of your equity. If you get 50% of both, if it's skewed a bit more, then you probability weight one side more than the other. Okay. So reality is a lot different, though, from the last few theoretical slides that I showed you. Sorry about that. So venture capital firms expect a 5-by-5 return, right? We talked about that before, which is basically a 500% return on their investment within 5 years, okay? And as we mentioned before, debt companies or companies that are pricing debt, just look at Moody's or Standard & Poor's to get what they think their return is going to be, okay? And then portfolio managers that work at big mutual funds or hedge funds, just look at basic portfolio construction. A lot of this math stuff is not really used. It's important to be exposed to it, though. All right, let's move on. Let's talk about securities law and venture financing, okay? So it's not hard, like I said before, to break the law by accident. If you do in finance, for example, or business in general, like if you're price fixing or setting up an oligopoly or whatnot, your jail sentence can actually be the same, if not longer, than murderers. It's crazy, I know. It sounds absolutely insane, but that's the case. So ignorance of business or securities law is no excuse. So let's talk about some very basic securities laws. Okay. So potential investors or prospective investors that might invest in your company, they all have to receive all relevant information before investing, meaning all risks have to be disclosed to them. And that's called an S1. And I'm going to talk a lot more about that later. So if you've been defrauded, you should receive compensation, right? And that's a basic security law. And that's why they have class action lawsuits. And insider information for publicly traded stocks is illegal and results in prison. And there's no excuses. And these are part of the US Securities Code or laws. Securities Act of 1933, this is a little bit boring, but I'm going to talk about it quickly, okay? This was created in the 1930s or 1933 because the stock market crashed in the 20s and created the Great Depression. And so the government created laws and basically allows the SEC or Securities and Exchange Commission to kind of watch out that no negative things happen to the market or no insider information and stuff. And laws haven't really changed since then, so I don't have to update them for you. So Securities Exchange Act of 1934 basically stipulated more laws on the law of insider information. Then we've got the Investment Company Act of 1940. And this basically regulates pools of capital, including venture capital, although venture capital firms aren't really regulated by the SEC, and neither are hedge funds. But I'm going off topic here. Okay, great. So let's talk about a recap of today's session. We covered a lot. Okay, so mature firms have many financing options. Startups do not. We learned about expected debt and equity returns and risk metrics. And we talked about how the world works from an interest rate perspective as well. So that was a little bit of macroeconomics there, but hopefully more interesting than the boring stuff you learn in school. And then we talked about ignorance of SEC laws is no excuse. And we talked quite a bit about ethics as well. Thank you.